Good morning, everyone. Thank you for joining the Vetiva breakfast meeting. Today, we'll be discussing investment opportunities in Eurobonds with Dapo Ojo. This will happen after the usual rundown of the equities and fixed income markets and other global updates from Frontier Africa reports. As usual, we'll try to make room for questions, but if we run out of time and are unable to take your questions during the 30 minutes allotted for this session, we encourage you to send your questions to research@vetiva.com. Also, this meeting is being brought to you by Vetiva Capital in partnership with Frontier Africa Reports and is currently being streamed on our Vetiva online Facebook page. And finally, it is being recorded and the recording may be shared with third parties. Today, we'll be starting with the fixed income market. Good morning, Omarege. You have the floor.
Good morning, Chima. Good morning, everybody. I'll start with the money market. Yesterday, system was very illiquid. Despite almost maturities of about 43 billion that came in yesterday, the money market opened 89 billion long. And this was a monumental decline from opening figures that we saw on Thursday, about 530 billion. So in spite of the low system liquidity recorded yesterday, money market rates losing to trade between 12% to 15% from the highs of 25 to 30% levels recorded on Thursday. So our expectation for today is that the money market will trade at similar levels in the absence of any major shock to the system. Moving on to the FS market, yesterday the Naira depreciated across all windows. This is on the back of the reduced FS supply in the market. The parallel market remained stable to trade at 485 Naira to $1, while the earning window traded at the high of 419.30 Naira to $1, closing at 410.50 Naira to $1. So earning industry turnover yesterday increased slightly to $40.80 million, coming from $35.55 million recorded on Thursday. Moving on to the T-bills market. The T-bills market resumed this trading week on a very moderate note with some activity observed, particularly on the NTB space. We still see players continuously trade cautiously across the curve. We saw offers on the newly issued one-year paper at around 7.45%. However, there were no bids on that end. We also saw slight demand for the long-dated OMO papers, particularly the February and March papers, but supply on that end remains very thin. Overall, the market traded sideways for both NTBs and OMOs, while we continue to see interest in the special CBNBs, but there are really no offers on that end. The special B were offered at around sub 6% levels, while players are looking at above 6% levels. We expect the T-bills market to trade very actively today as players shake off the holiday blues. I'll quickly conclude with the bonds market. The bonds market resumed this week on a very bearish note. Offers for the 2045 were around 12.1% levels. The highest offer we got on this paper last week was around 12%. We also saw mild interest across the mid to end of the benchmark curve. The bid and ask spread remains very wide. As a result of that, few trades were consummated across the board, except on the 2027, which traded around 10.9% levels. So our expectation for today is that the current sentiment will persist, given the tight system liquidity and the funding pressure in the market. That'll be all for fixed income.
Thank you, Omarege, for your analysis. Moving on, we'll hear from Seun on equities across West Africa. Good morning, Seun.
Good morning, Chima, and good morning, everyone. We start with performance of some markets in West Africa. We start with BRVM. The market sustained negative close we saw in the previous session as the composite index lost by 36 bips. We saw significant improvement in volume and turnover in that session with about 135% and 263% increase, respectively. Year-to-date return in the market still stands at negative 3.21%. Moving quickly to Ghana, the main index closed down marginally by 1 basis point, which is on the back of a 6.25% loss in one of the heavyweight Cow Bank, as Standard Chartered Bank was the only gainer in the session. Trade activity improved significantly as well in that session due to trades in MTN Ghana, Cow Bank, Total Petroleum, and Total Petroleum. The year-to-date return of the market in Ghana stands at positive 13.88%. And like we've always mentioned, investors who are willing to gain some access to that market can always reach out to us at dealing@vetiva.com. Moving quickly to Nigeria, the week started on a weak note with a 39 bips loss recorded in the session. We saw negative sentiment across all sectors, led by the banking subsector with about 167 bips loss. Investors sold off names like GT Bank, which lost 334 bips, Zenith Bank, UBA, amongst others in the banking sector. Also, Guinness, Boa Cement, and Oando also led the negative close in the consumer goods, industrial, and oil and gas sectors, respectively. Though we saw a few gainers in the small to mid-cap names, but this wasn't sufficient to tilt the outcome, the negative outcome that we saw in the market. On activity level, turnover declined by 7% in the session to confirm a quiet market, as most of the trades occurred close to the end of the session. So moving quickly into what we think of going into today, we expect activity level to continue to remain subdued as investors look out for catalysts to support a buy decision. We foresee a flat to slightly negative session, barring major upward movement in any of the large cap names. So market continue to remain slightly negative sentiment in the market generally. However, with the decline we have seen in the banks and some other fundamentally sound names, investors can begin to cherry pick these names for long-term investment. So that'll be it for equities market. Thank you.
Thank you very much, Sean. Next up are our media partners at Frontier Africa Reports, and today we will be hearing from Temple Ashaju.
Morning all. Quite a lot actually, but I'll try to shrink them. So we all know that the IMF meeting has commenced now, and they're beginning to release comments and analysis across the various regions of the globe. And something specific to Kenya and eastern part of Africa is their comments that the financial challenges to financial stability are expected to remain because of the virus and of course the limited fiscal support that they're experiencing at the moment. You all recall that the IMF actually released a 38-month facility to them last week under the extended credit facility, that's the ECF, and of course the extended fund facility program. I think it's around some $2.3 billion, something expected to help them finance that. So that's in the works, and they're studying all of that and seeing how they will, of course, be able to use this facility to sort all of these things out. So Kenya is not the only country that IMF has been able to release the funding to. It's released to quite a number of the developing countries that have also applied to them, Namibia inclusive, lately. But that's basically on the radar for everyone to analyze. Still with Kenya, we know that the United States has now stepped up plans to review the bilateral agreements with Kenya. Recall that under President Donald Trump, there are some bilateral ties that they were strengthening, especially with the US ambassador to Kenya, Kel Makata, who recently resigned from that position because, again, President Biden's administration is not in favor of all of those trade policies, environmental and geopolitical policies that President Donald Trump had put in place. So that is expected to be reviewed going forward. And Kenya had plans to pursue a free trade agreement with the US. Now that's where President Biden is back. He is more of multilateral strategy under the possibly through the AFCFTA with the feelers that we are getting across the news wires. It looks like it's the AFCFTA that they are going to probably leverage to also have this or sustain the relationship with Kenya. And the other thing with Kenya is that they're suspending passenger flights to UK come April the 9th. This decision is because, again, the UK has now placed Kenya on the red list due to the third wave of coronavirus in that country, something they do expect the IMF funding to help them address. Of course, we know that the projection for Nigeria from IMF now is that economic is basically expected to recover by 2.5% in 2021 and some 2.3% in 2022, given the macroeconomic circumstances or variables, the state of the economic variables that we have in Nigeria. A couple of other stories in the southern part of Africa, where you've got the IMF also saying that the debt and higher SDR supports, as well as vaccine among Africans, are some issues to continue to watch in the southern part of Africa. You know, we all know that South Africa also has its own peculiar form of COVID-19 and all that. And I mentioned earlier that Namibia has also received, I think, about $4 billion, $4 billion Namibian dollars, loan facility from the IMF. So something they applied to the funds about 2 weeks ago. That was released to them yesterday or thereabouts, when they made out all the funds that were requested by a lot of the developing countries. In the northern part of Africa, key for us will be the MLF Finance, which is now raising its capitalization to, I think, $200 million. Basically, they've got a bigger deal in the works. They're looking to raise some 2 billion Egyptian pounds by way of capital raising, and they do expect investors to be able to subscribe to that when the time comes. But the company is actually heavy in terms of mortgage, leasing, and some other form of integrated services in Egypt. These are our headlines for today, and thank you for listening.
Thank you very much, Temple, for those updates. Now to the highlight of today's session. We are joined by Dapo Ojo, who holds a Bachelor of Engineering degree in Electrical and Electronics Engineering from Nigerian University, as well as a Master's degree in Electronics and Electrical Engineering and Management from University of Glasgow, Scotland. He has varied experience in the financial services industry, including areas like treasury and liquidity management, currency and fixed income trading, fixed income portfolio management, both local and foreign portfolios, research, financial modeling, and reporting, and has also attended different global trainings on treasury management, financial products and services, risk management, fixed income trading, amongst others. He holds a certificate for risk in financial services from the Chartered Institute for Securities and Investment, as well as the ACI Dealing Certificate issued by the ACI Financial Markets Association. And he's currently the Group Treasurer at Vetiva Capital. Today, he joins us to speak on investment opportunities in Eurobonds. Good morning, Dapo. You have the floor to speak.
Good morning, Chima, and thank you very much. Please confirm you can hear me clearly.
Yes, we can.
Okay, good morning. Thanks for joining us today, everyone. My name is Dapo Ojo once again, and I work with Vetiva Capital Management Limited. Today, we're discussing investment opportunities in Eurobonds. And firstly, I'd like to remind us that market principles remain universal, either in Africa or Asia or anywhere else in the world. The only differentiating factor is the understanding and application, understanding with respect to the instruments you're looking at and, the application across market. Today, I'll attempt to highlight some of the things to understand and note with respect to opportunities in the Eurobond space, uh, relative to investor types and investor appetite, pretty much. First, I believe we all agree that before investing, it's important to have some level of understanding of what one is investing in and why, pretty much. So just a recap on the basics as we dive in very quickly. What are Eurobonds? They're basically fixed income instruments denominated in a different currency from that of the market or country where it is issued. By and large, they are debt instruments. They can be denominated in any currency. The dollar, for instance, we call the euro dollar. In the pounds, we call the euro sterling, and in Japanese yen, market refers to as the euro yen. And what does these instruments do? It allows the issuer, which the borrower had, to tap a market for a loan in a currency other than the currency in their primary market. So, for instance, Nigeria goes to the UK to issue an euro bond, um, allows Nigeria to borrow in dollars in the UK as against borrowing in naira in our market here in Nigeria. Um, what are the features of these euro bonds? Again, it is important to note some of the key features of these bonds before investing, as that really speaks a lot to what kind of, how much of return or how much of benefit you're able to derive from your investment activity. Um, First, we look at the credit rating. Credit rating speaks to whether they're investment grade or otherwise, which again starts to help us understand the attendance risk of default, possibility of default, the level of volatility you might expect to see or otherwise. Also, we look at the coupon rate. A lot of people mix this up. The coupon rate typically is the rate that is set when the bond is first issued, the first primary issuance. But when you then go into the primary market, you look at the yield, and pretty much you start to find out whether you're buying a bond at a premium or at a discount. The coupon rate also helps you to juxtapose your views based on where you're looking to buy the bond, the yield, current yield in the market, and your outlook in the near-term future. Again, price is also a thing to consider. That relates quite well with the yield. The relationship, as we all know, is inversely proportional to help you determine whether you're buying at a premium or a discount. So speaking on the yield pretty much talks about the current market rate. What is the market currently doing? What is the buyer willing to pay the seller at this time in the secondary market? That's when you're not buying from first issue at the primary market. Um, this is largely demand and supply driven, and you start to look at factors such as liquidity in that market, liquidity of that bond, cash liquidity of investors. You're looking at whether there's a fresh supply coming up soon. You're considering general macro fundamentals. What is the Fed doing with respect to rates in the US? What is the Eurozone doing? Does that release some level of capital for people to come into to the markets to chase these assets? And general global rates regime, pretty much. You also consider the face value, the maturity date. You look at the issuer. Issuer, generally, you're looking at corporates, multinationals, and governments, sovereigns, and these are the major issues of Eurobonds globally. Also, a quick highlight on the types of Eurobonds. You're looking at the straight Eurobond, which is the most prominent type of Eurobond that is in circulation. The straight Eurobond gives you a fixed coupon rate for the life of the bond, and it's usually redeemed at face value. You also have the floating rate bonds. The coupon rates on floating rate bonds are usually variable. They are equal to a reference rate plus a quoted spread, which is stated at the point of issue of the bond. We also have things like the convertibles, which can be converted into equities after a certain number of years. You have the callable bonds, which can be called by the issuer at a particular time during its life. And then there's a zero coupon bond, which is issued at a discount. It doesn't pay a coupon. I think Ghana 2025 bonds are discount euro bonds. Other variants would include reverse floaters and coupon step up euro bonds. Quickly to the benefits. What are the benefits of Eurobonds investment? First, it gives you a diversified investment portfolio. It helps you to achieve diversification. And case in point is our Nigerian case study. You want to manage your exposures. You don't want to be totally dependent on the Naira, knowing the historical performance and potential future performance of the Naira. You want to manage your exposures quite carefully. So Eurobonds are a good means of diversifying your portfolio. If you were to convert your Naira to dollars and keep in bank accounts, you probably don't earn much, given the current state of the dollar itself, and also given the country related issues. So, but when you purchase euro bonds, you're able to get some decent return on your funds, and also at the same time diversify your portfolio. Tax benefits as well, typical of fixed income instruments, no withholding tax. And then they are very highly liquid and tradable instruments. They serve as hedge instruments, and they also, like I noted, return relatively higher, provide relatively higher return when compared to what you can get in the local deposit market. It also gives cash flow stability. You have your coupons coming in twice annually, and given that there's a lot of scrutiny, there's some level of transparency with respect to the issuer, and also that gives the lender, which is the investor now, some good level of confidence with respect to investing in those instruments. Where are the opportunities for Eurobonds investment? The global bonds market, the Eurobonds market is estimated to, the global bonds market is estimated to be over 100 trillion, and Eurobonds are estimated to account for about 30% of that. That comes to about 30 trillion, according to ICMA, and you will all definitely agree that this is a sizable market with very clear inherent opportunities to cater to a wide array of risk-loving and risk-averse investors. So the opportunities are just, it depends on the level of attention an investor is willing to pay to the market. For the risk-loving investor, the market provides some good opportunity for you to latch on, whilst if you're just looking for consistent cash flow, I don't like risk so much. I just want to diversify my portfolio. The market also gives you some fixed return based on the coupon cash flows you expect over the life of a bond. Say you buy a 2025 Euro bond instrument that matures in the next 4 years, you're assured that you get a coupon twice per year for the next 4 years until maturity, and you can definitely plan your cash flow over the life of that instrument. Also, it gives you a wide array of investment outlets across sovereigns and corporates in different regions of the world. Where an investor is restricted to plain vanilla deposit from banks for cash, if I have dollar cash and I'm looking to just put in the bank and earn money market return, an Eurobond investor has the opportunity to look at different markets, different region. I can look at an Eurobond in Ghana. I can look at an Eurobond in Angola. I can look at an Eurobond in Nigeria. I can look at Turkey. I can look at London. And different places like that. So my opportunities are not, constrained to a particular bank or particular bank rates within a region. And it all depends on my risk appetite and my cash liquidity. Take, for instance, within the sub-Saharan African space, we have over 60 outstanding Eurobond issues. Nigeria has about 9. Angola, I think about 5 currently, whilst Ghana has about 11. If you look at the rest of the sub-Saharan Africa, you have about 35 issues combined with different risk characteristics and different yield profiles. Also, Nigerian corporates, we have about 8 outstanding issues across bank names with good, decent stability, and, one corporate issue as well. Generally, the opportunity here is you can look at and mix and match, and again diversify your risk, so you're not exposed just, for example, if you're depositing cash to one bank, you're not exposed also to just one country or one corporate. You can move things around, and where you're looking at trading opportunities in Eurobond investment, you definitely can start to look at the mispricings within different buckets and different regions and try to capitalize on that for capital gains. Again, I had spoken earlier about the fixed return risk averse investor, but for risk lovers, trading opportunities definitely abound in the Eurobond space. It gives investors opportunity for good capital gains return due to periodic market moves. And very quickly, I'd highlight the most recent history. In March 2020, at the start of the pandemic, at the height of the uncertainty, we saw yields on Eurobonds move up significantly to double digits, between 10 and 13% for Nigeria. I think Angola moved as high as 18%, at different times in March last year. And if you look at Nigeria today, the yields are now between 3% and 8% from, the lowest to the longest duration Nigerian bonds. And that's some decent level of move if you look at it. And therein lies the opportunity to make decent returns in the Euro bonds market. And for context, which is critical. For example, if you invested $100,000 in Nigeria 2025 Euro bonds in March 2020, and you paid 106,000 at 12%, $106,000. In today's market, which is currently at about 4.5 bid, you'd have made a profit of $26,000. That's over 12 million naira on your 48 million naira investments. Let's say we use today's exchange rate, and that's sizable. Naira, even at that time, investment rates were very low. And even at that time, Naira wouldn't have given you that kind of return. But yes, I hear you. That's an outlier. It's an extraordinary event. So let's pick a corporate, say EcoBank 24s or Fidelity. In January this year, if you had bought EcoBank 24s or Fidelity 22s, at some point in February, say in January, you bought at 6.05, the Echo Banks. In February, you'd have had the opportunity to exit at 5.80. And for a trading investor, I'm always looking to just maximize returns. That's where the opportunity is for you, paying attention to the moves in the market, staying close to your portfolio manager or your relationship manager or the experts generally to give you guidance and expectations and views on market. Generally, it is market volatility that drives this kind of return, and they can lead to very high capital gains where opportunities, present itself. Like I noted, it's very important to pay attention to such things to be able to harness that opportunity. For another investment opportunity, another opportunity to make good returns or maximize returns on Eurobonds is to find mispricing opportunities between buckets. So a Fidelity Bank 2022s is currently better offered than a Zenith Bank 2022s because of their different risk profiles. And when you go into sovereigns as well, you see that such opportunities exist as well. You might be looking to switch from Nigeria to Ghana at this time, or move back from Ghana to Nigeria at different times. Those opportunities present itself, and the opportunities to, lock in decent returns on your Eurobonds. The factors responsible for this performance would include yield differentials, like I noted. It's largely demand and supply driven. Demand on a bond at time A might be different from demand at time B, and that starts to give you some good opportunity to quickly go in and lock in returns based on that. Market dynamics also is a strong factor. Market conditions generally weigh in on bond performance at different points in time. And so it's important for an investor to pay attention and position strategically to take advantage of the positive dynamics. The underlying currency is also a factor to note. The strength of the currency underlying the Euro bond, be it dollar or pounds per time, would also impact, either positively or negatively on the performance of the bond. The term to maturity is also what you need to note. As an investor, to take advantage of these opportunities, what you need to do is to understand your risk profile, work with your portfolio manager, relationship manager, or experts to determine exposures you're interested in. Plan your capital or cash flow to avoid undue pressure. Stay close to the market for constant update and get updated information regularly on trigger events. You need to also make sure you do regular periodic review of your holdings against market outlook. The constraints in that market will be the minimum trade size of $200,000, which is what the standard lot that trades in the market. The risk also of that market risk, price risk, general volatility, and that's where you need expert advice per time, so you don't pick up bad holdings. Also, in our own local space, we have the FX challenges with respect to transfer of funds and all of that, but that can't be forever. And in spite of the restrictions, we've seen investors still sourcing dollars, maybe more expensive rates for transfers than cash market, but your objective will determine how quickly and how much you want to put into sourcing the dollars and getting your investment done. Now, how can we help as Vetiva Capital? Given that the trade size of 200,000 might be significantly huge for some investors, we grant you access to the market at lower lot sizes. We're able to fill you for, comfortably for $50,000 interest at a minimum. We also try to find a balance for lower sizes depending on market timing, and it's usually on a case-by-case basis. Also, we're able to give you market color and guidance as to what you should be investing in, as to our views with respect to market performance in the near term. Execution, we're also here to give you market competitive rates and best execution amongst the things we hold there at Vetiva. Our fee structure is relatively, moderate as well. We charge 1% flat fee annually on the face value, and we take this when your coupons come in semi-annually for convenience for our clients. Given the current dynamics and our outlook, guidance at this time is to limit your horizon to the short term to 5 years if you're looking to invest at this time. We currently see opportunities in Fidelity 22s, Echo 24s, Nigeria 27s, and Ghana 27s. I think I'll round it off here for the sake of time. Thank you very much, Chima, and thank you everyone for listening. Chima, over to you.
Thank you, Dapo, for the very insightful presentation. For our audience, please use the raise hand function or the comment sections if you have any question for Dapo. I think we may be able to take at least one question. All right, I see that we have no question for us today. So we have now come to the end of this session. We thank all our speakers, especially our guest speaker, and all the participants for joining us today. We hope that you found this insightful. We encourage you to maintain the recommended safety guidelines, and we hope to see you tomorrow at the same time. But do you have something to add?
Okay, I noticed there's a question in the chat box. What is the future of private Eurobond in Africa? So if I may just quickly make an attempt on that. The African market is still developing, as it were, and the future is very, very robust, if I may use that word. The opportunities abound, and depending on the corporate entity I'm looking to come into the market to tap their credit ratings, their performance history will be the things. But again, when you continue to look at the fact that in developed climes, the yield, the return outlook remains very low, as it were, and investors will keep searching for yield. So it continues to paint the picture of how much of opportunities abound with respect to companies looking to raise funds and investors looking to tap into the Eurobonds market.
Okay, thank you, Dapo. I think there's another question. So quickly, I don't know if that's the one you answered. From Ari Daramola, what are the current yields on the corporate Eurobonds and what will drive yield adjustments if I were to take a trading view?
So currently at this time, current yields, we've seen Fidelity 22s, the best offered given the risk profile as well at about 5.1 indicative in the market. EcoBank 24s about 6.1% in the market. And these are the better priced with respect to offer compared to peers around that maturity bucket. Those will be our investment advice. If it were to be a trading view, again, yield adjustment at these times will be driven by who is coming to the market to tap. So it's important to pay attention to these names to see whether there are whispers as to whether they're coming in to tap, whether anytime soon. For sovereigns, Nigeria, though the government has said that, repeatedly said that they won't be looking to tap the Eurobonds market. Market is starting to think otherwise when you look at where local rates are currently at a double digit on bonds. And if you look at the Eurobond space, yields are single digit. So it starts to present an opportunity. First, you're able to shop the FX reserves of the country, and then you're able to borrow cheaper. It's also okay to note that, FX valuation over the next couple of years might balloon the total external borrowing regardless. But those are the things you start to look at to consider to take a trading view. But at this time, your capital, your cash you're putting in must be able to wait for a prolonged period. Market has been slightly on the sell side in recent times, and this is largely driven by what the US is also doing with respect to trying to push inflation globally and trying to force yields up. But nonetheless, it's the opportunity is there. You just need to have patient capital. In between, say, a month or two, you might see some 20-30 basis point spread that you can quickly catch on. But the trading view at this time, you might need to sit and wait for a more prolonged period. But again, the things you need to look out for is what is the level of demand in the paper you're looking to buy. What is the supply? Is the issuer looking to come into the market anytime soon to raise more funds? And how does that impact? When they come in, it means what is being issued will most likely, looking at current market levels, you most likely be getting at a better yield than what it had bought in the secondary market. And so those factors are things you want to be clear on before making an investment decision at this time when it relates to trading. But you can reach out. I'm looking at the time. You can reach out for further inquiries, and we can take this conversation up afterwards.
Thank you very much, Dapo, and to all our participants. Once again, we thank all our participants and speakers for joining us today. We encourage you to maintain the recommended safety guidelines, and we hope to see you tomorrow at the same time. Thank you for joining.